we do and how we look for setups. I mentioned beforehand that we would be looking for the higher dollar, which we got. I mentioned specifically the run on the sell side liquidity for the cable, which we got. How do we go in using the confirmations that I try to give you by way of the commentary I give you on Wednesday and or Friday or Saturday weekend review? If I'm drawing your attention to specific points from a higher time frame, I want you to practice using the lower time frames to get in sync with that. Many of you follow along with that and you get really good results. A few of you, and some of you are actually from my first group, ignore the things I talk about and you trade other pairs in the opposite direction and you're struggling. And it's very frustrating for me as a mentor, because if I spend the time to talk about specific points of reference in higher time frame charts in euro and cable, it's not something that is encouraging as a mentor when you send things to me that you traded in Canadian dollar or pound yen, okay, or dollar yen, which I don't cover those pairs. I don't do those pairs. I want your focus on euro dollar and GBP USD with the dollar index. Once in a while, like I mentioned, we look at gold. I felt that bringing in gold wasn't a fair thing to do. It doesn't require a lot for me to talk about it, and it's outside of the scope of the two forex pairs that I cover all the time, so it breaks up the monotony. But you want things to be monotonous. You want it to be boring, and the only way it's going to be boring is if you see the same things happening over and over and over again in the same market or markets. So when we had the week open here on Sunday, we had a gap. We have a small little gap in here. It gaps, comes back up and fills that gap in, but trades a little bit more above the short-term high and trades into a buy-side liquidity pool, and displacement comes in. Inside this particular day, we already knew that the low here, the old daily low, which is 120.14.5, is really what it was, but I don't know why it's showing here on that line like that, but basically 120.15, we'll just call it. That's what we are looking for as the draw on liquidity, and the liquidity below that, because the old daily low, it's not going to be 10, 20, 30. It's going to be a more significant run below that because it's a daily chart. Inside of the Monday's range, let's go into a 5-minute chart. All right, so we have price running into a Judas swing, old high, buy-side liquidity pool, and we wait for price to create a displacement. We have one single pass down here. Previous candle's low. $21.68 and 8 pipettes. The next candle after the down displacement is $21.66. This is a fair value gap. We want to see price trade up into that. We could be a seller there. Stop above here. We have another imbalance here. What are we looking for? Remember, this down here is where price is being drawn, and below that. So every time we get a single candle, okay, we get a single candle like that, and then we have the previous candle which does not need to be an up or down close. It's just, and I'll show you in a second what I mean. When I'm drawing your attention to a lower higher time frame level, the only thing you need to be practicing and worrying about right now as a developing trader is this. You're going to find 3 candles, okay, in that range that exists between the first candle in a series of any consecutively printed candles One candle, the second candle, only one pass down. Then the next candle stops inside of the range of this candle. So between the high and the low, in other words, the low and the high, the next candle here, or the third one, doesn't completely come all the way back up to the previous candle that creates that one single candle down here. So your eye needs to be trained, and this is why we were doing that fair value gap back testing exercise that you guys went through, because it teaches your reticular activating system in your brain to identify this pattern. So when I look at charts, my eye goes immediately right into here. I see that. So I know I want to be a seller inside that blue area. And it can be as easy as just getting it to the bottom of that one. So the next candle that trades up ever, how long, Michael? I don't know. It's a limit order. Hit it, sell short there, and the stop would be whatever the previous swing high would be. Go about 5 points above that. Okay, or 10 pips, depending on what your risk model will permit. If you're trading 1% or less, it doesn't make a difference how many pips it is, because there's not going to be that much damage to you. And you're up here. You have an entry here, and you have an entry here. Follow along. We have a displacement here. This candle is exactly like that one. Just like this candle here is just like that middle candle here. This candle here is exactly this candle here. So this shaded area, that's your fair value gap. This is your institutional order flow entry drill. Selling at the nearest easy low-hanging fruit entry. You sell short there. Okay? So selling short here or selling short here, you know, you can demand it to trade all the way back up and fill that in. There's nothing wrong with that. Problem is, you may not get a fill because it may just go up to the bottom of the gap and then roll over. And everyone, if we were to compare notes when there's a fair value gap, the high that goes into the gap is always going to be different across your live broker, because they're always going to be slightly different. And that's the reason why I teach low-hanging fruit. Low-hanging fruit is the easiest entry concept when there's a directional bias using the fair value gap. But you have to be aware and be willing to absorb the drawdown that resides between this candle's high and this candle's low. So it may go all the way against you. If you're just trying to sell short here, you may have drawdown to whatever degree this range is in terms of pips before you even start to encounter what would otherwise be your range in pips that would be in your stop. So you have to be mindful of that, okay? You have another fair value gap here. Okay, you have this candle is this one. This candle is this one. This candle is this one. So it needs to only go above this candle's high or trade to the same high. So 121.01, and it does so here. Your next candle you're selling short. Where's your swing high? Right here. Put your stop just a little bit above it. Right in here. So you're selling short here. What are you looking for? A run to that level. Does it get there? Not in a straight line. Look at that. All this time, if you're watching a 5-minute chart, that'll drive you crazy. And then here you go. Boom. See that? Now, when price hits that old daily low, watch what happens again. You have displacement. Okay? Before you get to the old daily low, watch what happens. You have displacement, one single candle. So you have that 3-candle pattern here. 1, 2 with one big candle in the middle down. So it's a lot of sell side imbalance. The next candle's high is 20.26. So you put a limit order. Okay, you want to sell anything at 120.26 or higher. Next candle we open, trade above it. There's your fill. You're selling short. What's your target? Initially, it's this low, the old daily low rather, at 2014.5. And then you're looking for the liquidity, expanding below that, seeking a deeper measure of sell-side liquidity because it's a daily chart. We have another fair value gap here, big displacement, 1 candle, 2. Here's the candle's high at 120.19. What am I supposed to do, Michael? You can sell short at 120.19 or higher. The next candle, 120.19. Fill, short. Where's your stop? Here's your swing high, so your stop has to be above here. What's my target? Well, you've already traded to the old daily low. So now you got to look at the daily low. We have 120.14. We're a daily chart. Is it reasonable to expect it to trade down to the big figure 120? Yes. Well, let's put that on there for a moment. So we have big figure 120. Okay. And the protocol is when we get to a big figure, we can expand as much as 40 pips beyond that. So in this case, we have 120. So what's 40 pips below that? 119.60. I didn't make that rule up because it works good here. Everyone in the mentorship knows this rule. If we trade down to a big figure, we don't just look for a 10, 20, and 30. It can expand as much as 40 pips. So let's put another level in to 119.60. And we'll just put a different color. So 119.60 is 40 pips below 120 big figure. Okay. And entering here with the expectation of trading to the big figure, take something off. And then what's 10 pips below that? 119.90. So 119.90 here. Take something off. Let me put some of these markers on. So 119.90 here. 20 pips. 119.80. Take something off. 119.70. Take something off. And then the last portion at 119.60, which is 40 pips below it. Obviously, if you're looking for 40 pips run below a big figure, perfect world would be 119.60 getting out. That's the 40 pip range, but we have to always factor in the spread, and I like to use a 5 pip buffer for that. Okay, so you'd be looking for 119.65 or slightly higher 119.70, and just be content with it reaching to your target, but not trying to get out at the absolute low. Price hits it, hits it, hits it, starts to run higher, and there you go. There's your smart money reversal. Using everything and all the signatures that I teach you in the core content. Where and how they form is going to be an experience for you studying. So the question is what do you do? What am I supposed to be doing every day? Well, if I give you the higher time frame levels and the draw on liquidity, you look for these types of things. Now, this is just one way to trade using my concepts. This is not the only thing I teach. It just happens to be the flavor of the recent couple months. We're going to go into other PD arrays. We'll be revisiting order blocks, bearish and bullish. We'll be doing breakers the same way. We're going to be doing vacuum blocks, which I have not spoke on at all. We're going to be doing a lot of stuff. Okay, but I have to start somewhere, and I just happen to use fair value gap because I think it's easy next to optimal trade entries. So I believe that I have done you a great service in this video. If it doesn't feel that way,